In the last video, I compared the internal rate of return of an early cash value whole life insurance policy to a high yield savings account. And in that particular example, due to the effect of taxes over time, the high yield savings account would need to get 6.4% every single year for 30 years straight to match the internal rate of return of an early cash value whole life insurance policy. But wait, there's more. In the interest of time, in the last video, I only showed you the effect of taxes over time against a high yield savings account, since that is by far the biggest impact to the rate of return of the high yield savings account, versus an early cash value whole life insurance policy. There are two other potential aspects of true comparison that I left out in the previous video. The first one is for term insurance, and the second one is for management fees. So, to be fair to the high yield savings account, they might say, well, I can just buy cheap term insurance and for the death benefit, and then I can buy term and save the difference or save the rest, as they'd say. But what you need to remember is that term insurance has a cost. So, we need to factor that in. So, okay, let's go take a look. Okay, so now I'm sharing the funding illustration calculator, and this time you'll see that I'm on the permanent life insurance tab. And notice this column here, the death benefit column. And it's 1.14 million in the first year and 1.194 in the second year, etc. So now I'm going to switch over to the alternate account, which is the high yield savings account. And you'll see here that there is no death benefit yet in the term insurance death benefit column. The very first year of the whole life policy had a value of 1.14 million in death benefit. So what I did is I got a term insurance policy for 30 years for the same 35-year-old healthy male, and I illustrated that out, and that's what I'm going to be using. So at least we have at that very first year the same death benefit, so that the high yield savings account has a death benefit to compare against to the early cash value whole life insurance policy. So I'll click this insurance term button, and you'll see there it's that same 1.14 million 632. That is so for every year for 30 years, we have that death benefit. And then you'll notice there's the cost column, the term insurance premium. That's the cost of the insurance every year. And if we switch back to permanent life insurance, see it's that same first year. It's $1.14 million in death benefit. But what I want you to notice is look at the next year, 1.194, and the next year, 1.246. You'll notice that the death benefit in the early cash value whole life insurance policy is growing every single year. And the reason why it's growing every single year is because that's by design. I designed this contract in such a way to take advantage of a contractual right that you have, which is called paid up additions. And at the end of each year, your dividends can go to a variety of different places. You could get the dividends back as a check. You could use the dividends to pay premium. But another option was you can use the dividends to purchase up more death benefit, more paid up additions. It's increasing the death benefit every year, but every time you increase the death benefit, you realize a tangible cash value increase in your policy that you can borrow against and utilize. And so you'll notice that every single year the death benefit is increasing. Where if you go back to the alternate account, every single year the death benefit is the same because it's a flat term policy. And so now we are being fair to the high yield savings account by adding in cheap term insurance, but we need to be fair back to the whole life insurance policy because that term insurance has a cost, and that cost has an effect over time. And that's what's great about this calculator. It shows that cost over time when you factor that in. And so now when I click on this button, you'll see that the cost of the term insurance, its effect on the high yield savings account and the cost of it over time, the high yield savings account would have to get 6.63% now. It used to be 6.4%, but due to the cost of term insurance over those 30 years, it would now have to get 6.63% every single year for 30 years to be equivalent to the internal rate of return and the cash value availability that you would get in the early cash value whole life insurance policy. So now this makes an even stronger case for early cash value whole life insurance policy against a high yield savings account. And I'm going to watch for another video I'm going to be creating that shows the true cost of term insurance over the same time frame as whole life insurance, because whole life insurance is permanent life insurance over your entire life. Term insurance is insurance over a fixed term. And when you actually run the term insurance over the entire life, let's say the age 100 or age 95, you will see that term insurance is by far more expensive than if you would have just got whole life insurance. So I just showed you the effect of taxes over time and the effect of the cost of term insurance over time. But wait, there's even more. Now let's talk about management fees. Because if you really, now we're getting 6.63%. You have to get that every single year for 30 years. So let's just be honest. Where can you expect to get 6.63% every year for 30 years? You can't get it in a savings account. You can't get it in a CD. You can't, this is February 2025. You can't get it in a CD. You can't get it in a bond. So the only other option for most folks would be to go to the market. But the thing about that is now you are moving into a place that has risk, a place that has a loss of liquidity. And now, since you're giving your money to somebody else to manage, there's a cost involved. And to be fair to the early cash value whole life insurance policy, we need to factor in that cost over time. And that cost can be significant. And also note, with early cash value whole life insurance or whole life insurance in general, the fees are already baked in. There's no surprises. So that illustration you're seeing, those guarantees you're getting, those are net of fees already. So there's no surprising fee shock at the end that you might get in some other assets or some other products. It's already factored in. So what you see is what you get, another positive benefit for whole life insurance. So now we're going to go back to the calculator and I'm going to quickly run through a few scenarios of just throwing in some fees so that you can see what the impact is of those fees over time. Okay, so now we'll go to we're on the alternate account tab of the calculator. I'm going to click the management fees button. And my first example is going to be a 0.1% fee. I looked up Fidelity, Vanguard, S&P 500 mutual fund fee, no load fund. And in its literature, it said it was a 0.1% fee. So I'm going to put in 0.1% fee. And I'm going to turn on the internal rate of return. And we're at 6.63%. Now I'm going to put in a 0.1% fee. And now it goes from 6.63% to 6.77%. Your high yield savings, well, or your market account would have to get 6.77% every single year for 30 years to match the internal rate of return of the early cash value whole life insurance policy that I'm showing. I did a search to see what is the average of fee for assets under management. That came back at 1%. So if you put in 1% as a fee, your market account would have to get 8.01% every single year for 30 years to match the safe, guaranteed growth of the early cash value whole life insurance. There is no volatility with whole life insurance. It's a non-market correlated asset. It doesn't move up and down with the market. It has been slow, steady, predictable growth. And the companies that I work with have been doing it for 130, 150, 175 years and they've never not paid a dividend. So they're really good at it. We also see a lot, 1.5%, that gets modeled quite a bit. I mean, that would be 8.72% you'd have to get every year for 30 years to match the growth. So that's the thing you need to factor in. Taxes, term insurance, and fees. So if you have cash and you want to save it in a place that has a really great internal rate of return and at the same time provides protection for your family and at the same time has cash value that you can borrow against that can be used for life. It's a living benefit. I highly encourage you to consider early cash value whole life insurance. I've been using it for 7 years in my family. It's the foundational financial component of protection, and it's our family bank. It's our family banking system. So after 7 years of building up this cash value, I don't have to go to banks anymore. For opportunities, for buying a vehicle, for renovating the basement, for replacing a furnace. I can just, utilize the cash value that I have in my policy. And it just gives me that control and that certainty back in my life. I don't have to go to the bank hat in hand, hoping that they will give me money. Give me my own money that I've been giving them, right? So if this resonates with you, contact me. I'd love to work with you. Show you how you can get an early cash value whole life insurance policy set up in your life, how that can become the foundational kind of financial foundation for your life and your family. So please comment, put in, if you have any questions, add some comments, make sure to like and subscribe and share and reach out to me. I'd love to work with you. Rob@cashlifefinancial.com. My contact information is in the notes and I'll see you in the next one.